Hello, and welcome to the Three Questions podcast, where we dive deep into the world of wealth management and connect you with industry experts. I'm your host, Wayne Baxter, Senior Executive Manager at One Capital Management. Now, if you or someone close to you are facing rising premiums on your property and casualty insurance despite talk of falling rates, or maybe you're wondering how to safeguard insurability while building a new home in 2026, stay tuned. What's our topic this week? The three questions high net worth families should ask when thinking about renewing their property and casualty coverage in 2026. Thank you for taking time to check us out. And if you enjoy this episode of the Three Questions podcast, please consider liking this video and subscribing to our podcast and YouTube channels. Now, today we're exploring the three questions high net worth families should ask when thinking about renewing their property and casualty coverage in 2026. So this year we have evolving climate risks, market fluctuations, and increasing asset values. High net worth families need protective strategies to maintain insurability, control costs, and ensure comprehensive coverage, avoiding gaps that could jeopardize generational wealth, especially for those with properties across borders or unique collections. Joining me on the Three Questions podcast is Joe Young, Senior Risk Advisor with One Insurance Services. Joe works with successful families, individuals, and their trusted advisors to create custom risk management and insurance programs to protect what matters most to them. Based in Fort Lauderdale, Florida, he brings a deep expertise in areas like homeowners insurance, flood coverage, excess liability, and umbrella policies, and also insuring exotic or luxury vehicles. Drawing from One Insurance's services client's first approach to tailoring solutions for high net worth lifestyles, including protection for private homes, classic cars, boats, and more. Joe, we finally got you on the podcast. Great to see you. Thank you for making time for us.
Wayne, it's a pleasure to be here. Thank you for having me.
It's going to be fun today. We got lots to cover. And we were talking before we started recording that, hey, what do we notice here? One Insurance Services and One Capital Management. We are, what did you say? The one podcast we should be listening to.
One podcast you should be listening to.
Or watching, either.
Yes.
Because we are actually on video too. Okay, so Joe, before we get to our three questions, we got a lot to cover and I got a ton of questions. Let's touch on a few specialized areas where you have expertise that tie into the high net worth property casualty strategy, that overall sort of environment. Now, given your Florida base, and we have increasing climate events, or so we're led to believe, why is standalone flood coverage essential for high net worth homeowners, even outside, and I'll put in quotation, designated flood zones? And what trends should families watch for this year? Over to you.
Wayne, great question. I'm going to start by saying if your home has a zip code, you're in a flood zone. And I've learned that from a great industry veteran I've worked with for many years, from a
if you have a zip code, you're in a
flood zone, right? FEMA creates these maps and just about every home has one. Now
this is applicable for Florida though, right? So we live in the Canadian.
Oh, and this is for the US, yeah, not for Canada, but for the United States. If you have a zip code, you're in a flood zone. Now, maybe a lower risk flood zone where a bank may not require you to purchase coverage, but doesn't mean you're at risk. So the NFIP, which runs the National Flood Insurance Program, will say over 25% of their claims come from properties in those low risk flood zones.
Interesting.
Mother Nature doesn't really look at maps. She does what she wants to do. Key problem with the maps is they're old. They're outdated. By the time a map gets approved and government, efficiently puts their processes together, construction has changed, landscaping has changed, new development changes risk. And they also don't consider pluvial flood data, which is rainfall, which half of the floods down here in South Florida are from rainfall events, not from flooding or surge
hurricanes.
Hurricanes. The surge events are more on the west coast of Florida than the east coast of Florida.
Right.
So I feel like everyone should have flood coverage. If you're on that southwest coast of Florida, especially, you really need flood coverage and excess flood coverage to make sure you are fully protected. Because the building code is better for wind than it is for flood as well. So we really want to make sure that, God forbid, something bad happens, that your property is protected as best as it can. That could be your home and contents, and even your automobiles, but those are covered by your auto policy.
Joe, you're like just think about this as you're talking. You're really well connected with underwriters, obviously.
Yes.
Do you guys ever talk about this whole thing about the potential for the rising water table, even on your side? Like you're in Fort Lauderdale, right? So over on the east side, you ever talk about this I mean, I've heard people talk about the potential of five, the water table rising in South Florida, like over the next
Well,
eight. Is that a conversation you guys are having, or
to be honest, Wayne, not right now. I mean, they've been saying for years that Miami should be underwater by now, if we go back to like the 1980s and 90s,
right,
right, with
right,
global warming.
exactly.
But the cities and governments, I believe, put a lot of effort into infrastructure and making, changes to control that. So talking to one of the private flood underwriters, the Tokyo Marine Group, they actually feel like Southeast Florida, at least, is a much better risk than some of the maps and rates change because we have the Bahamas, we have the Barrier Islands that help protect us from the surge coming in. Also, the Atlantic Ocean, you go out about a mile, it gets very deep. Or the Gulf of Mexico on the west coast is a very shallow body of
Right.
water. So it's much easier for winds to push that water in and cause those surge events like we saw in Ian and Fort Myers. They feel it's very unlikely to see that, on the southeast coast at least. And I think history's shown us that.
All right. So this whole notion that we could see the flood, the water table rise by 5 feet over the next 25 years is like not something that people are staying up at night worrying about.
They're not staying up and worried about that now. I mean, and I know we'll talk about this later. There's a lot of data analytics, AI that are doing a lot better modeling they have done in the past. But even being here in Fort Lauderdale, the city hall, the commissioners have put a lot of work into floodplain management and pumps and and ensuring, if water comes in, can they get it out to the Everglades as quickly as possible.
Interesting. Okay. Well, if you could send some over here to Southern California, it'd be okay. Well, that's
Yeah.
another
And Wayne, let
story.
me just add to that too, something we did t cover earlier. Being away from the coast doesn't reduce that flood risk.
Not in
Like I
Florida. No,
mentioned,
I
not in
realize that.
Florida. Rainfall doesn't look at the coast, and most of coastal flood protection involves pumping the water out west to the Everglades. So the water has to go somewhere. So it's going to go to the communities that are 5, 10, 15 miles out west. So the risk is just as strong in the western part of the county than it is on the shoreline.
Oh, by the sunrise there where the hockey arena is, it's just as much of an issue there that it is right on the coast.
It can be, yes. All the
Interesting.
flood canals, the canals all head west. That's how they pump the water from the beaches and everything else. So yes, it's just as big a concern out there.
Can you, okay, so I'm glad we chimed in on that. I wanted to get your perspective on the flood part. I'm going to change topic. This is a topic that we talk about here on the podcast regularly.
Mhm.
Uh, as you know, we're recording, or probably our podcast, is heard, watched, not just here in the U.S. but also in Canada.
Mhm.
Uh, and in Canada, there's no such thing as umbrella insurance at all. So when Canadian families are relocating here to the U.S. and I'm working with them, one of the first things we talk to them about is the importance of liability coverage here in the U.S. And so just for the folks that may be listening to the podcast for the first time, maybe they're, in Canada and they're thinking about relocating to the U.S. Maybe you could just maybe take a couple minutes and explain why umbrella policies are a must for high net worth families. Again, beyond the basic property and casualty insurance, which we do obviously have in Canada, and how they protect against lawsuits or large claims. Because in the U.S., this is no news to you. It's much more of a litigious environment than we're used to in Canada.
Agree. And when you're covering my two favorite topics, flood and umbrella policies, and I think
Okay, well there we go.
I'm happy already. And I think every family or individual should have an umbrella policy in the U.S. So an umbrella policy, its basic form is an excess policy, a secondary policy that provides additional liability coverage over the limits provided by your primary liability policies, whether that's your homeowners, your automobile, if you're operating a watercraft or yacht, an ATV, snowmobile, toy. Unfortunately, bad things do happen. You said it right, Wayne. We are in a very litigious society. If you drive down any of the highways here, I think 9 out of 10 billboards are for a law firm, bragging about how much money they got their client, from an insurance company or the other party.
The best storytellers are the guy, the prop
Yep.
are the personal injury attorneys.
Attorneys here. Yep. So,
They always have crazy stories, that's for sure.
but while the claims are less frequent, they're for those low probability, high severity events like an auto accident. And they're accidents, but they happen, or a jet ski, personal watercraft. So, God forbid you are at fault, found negligent. These policies are going to A, protect your net worth and your assets instead of having to use your own expenses. And also, just importantly, the insurance company is going to defend you. So if you get sued for an accident, killing someone, hurting someone, severely disabling them, you don't have to worry about hiring counsel because the majority of umbrella policies are going to include defense outside the limits they carry. So my recommendation is everyone should have an umbrella policy, even a younger professional, because judges do also look at future earnings potential as a way to put judgments on each other's. And these policies, you should look at your net worth, look at what's exposed, but also talk to your team. It shouldn't be my decision. It shouldn't be your decision. Your CPA, your attorneys, your tax attorneys, everyone should be part of that conversation to determine what you need and how much coverage you should get. But it's a policy everyone should have. If you don't have one, we'll be glad to talk to anyone offline about that.
Okay, I'll confide in you. When I first
Yeah.
moved here, one of the first CPAs I talked to, because me, I'm a financial advisor moving from Toronto down to LA, right? Setting up a new practice. He says to me, you got any umbrella insurance? Now, I'll confide you what my answer was not the sharpest. I said, what's that?
Okay. But listen, it's good that your CPA asked that question because they
Yeah,
should
he
be.
did. He said, well, you damn well better get some and soon, was what his
Yeah,
response was. I'll never forget it. It was
yeah. Because he wants you to have, assets to protect, right? That's really the goal of that. He doesn't
yeah.
want everything you've worked hard for to go to someone else. He wants you to keep it for yourself and your family.
Now I have a different company I'm
Yeah.
working with now, but it turned out I phoned, like literally had the conversation back to my office, picked up the phone and contacted my then insurance broker, and they confirmed with me that they had included it in my plan. I just
Didn't know.
ignorance is bliss, right, Joe?
It's great. That's great that you had it there, Jess. If
And
you
the
need,
mother of adventure too. So yeah, umbrella insurance. If you're a U.S. resident, it's a must.
yeah. And when I'm
Especially
going
if
to add
you
it, if
go
you're a high
ahead.
net worth individual, juries look at you as in a different light and say you have extra wealth and money, and the verdicts are getting more nuclear and higher than they would for the standard person. So you got to realize if it gets to a jury trial and they see that you have extreme wealth and means, they're going to have higher judgments than they would against the average person. And the other issue affecting liability and I think it's a huge issue that hopefully will get resolved through legislation at some point, is litigation funding, where private equity and hedge funds are funding litigation looking for a return on their investment. So a simple accident now could have the hands of Wall Street behind it, looking for a greater return because they're paying for the upfront cost
So
to
would
go
you?
after someone sue.
I got one more question. You see, Joe, I knew this was going to happen, that we were going to go off on a tangent here, but that's okay. So do you think that the asset protection strategies that attorneys put in basically complement the the umbrella policies? Do you look at them as a sort of a tandem?
I do. It should be part of the plan. It shouldn't be you shouldn't have one tool in your toolbox. You should have multiple tools. And there are great tools that financial planners and attorneys put in place that I'm not allowed to talk about because I'm not an attorney or a
I
financial planner.
realize that, but
Yeah.
just
No.
from
But that's why it should be part of the conversation from your whole, wealth management or wealth team, is it should be part of your solution, but there are other, products and ways to protect that. But this will be there to cover any gaps. The other important part, Wayne, is when you talk to your insurance broker, is make sure they ask about your estate planning and everything you've done with those other partners. Because if you have assets protected by corporations and trust, that needs to be disclosed in the policy too, to confirm that all ownership is out there to avoid a denial of claim or coverage for lack of, you know, insurance matching ownership T to T.
that's a sound advice. Okay, we're going to turn off. One more area that I wanted to chime in on. This is more of a fun one. Is for clients that have classic or high-end cars, and what I wanted to hear from you is regarding specialized coverage and how it differs from standard auto policies. And are there any steps that a client could take to ensure these assets are fully protected even during storage or when they're being moved? Say if a client of mine is bringing his classic car down from Toronto down to South Florida or here in LA or Scottsdale. Uh, I'm interested in your thoughts on that in that space because I know that's an area that you also like to work in.
We do like to work in that. And Wayne, there's standard auto policies which cover the general market, your daily drivers, whether it's your
Hmm.
Lexus, your Honda, Toyota, Hyundai, all great cars. But for the true passionate collector, there's a whole separate little subcommunity of companies that specialize in that. And most of these were created by those collectors. So some of the benefits of those are they understand the lifestyle of the collector and the usage of the collector, right? Most collector cars aren't driven as much as your daily use car. Most collectors love their collector cars almost as much as their family, sometimes more. There's a emotional attachment. So what a lot of these companies do is they offer first an agreed value policy, which means you pre-negotiated the settlement if something happened, and they will help you with the valuation. A lot of these companies. They also include things for like tools and parts and modifications and customizations. Where a State Farm policy, and they're a great company. If you had a claim, they're going to say, what's this car worth after a loss? What's this actual cash value? That doesn't work well for a standard car. They're going to push, I use the word OEM, which is original manufacturer's equipment when available for some cars. So they're not using third-party after parts, which aren't bad, but the quality is not the same, especially true to a collector. They want to keep the car as original as they can. It also could be a safety concern. In regards to risk management, a lot of times they'll talk to you about how are you transporting the car. A lot of these companies, I'm going to say Haggerty is one of the bigger names. They have professionals that can make recommendations, provide vendors, help you with plans, storage. In certain areas, I'm going to pick on California and Florida. They may require the cars to be in certain facilities at a higher elevation or fireproof, facility. In the event of a hurricane, they may assist you in evacuating your cars to higher ground or a safe facility if you don't have that. So there's companies that focus on these communities of passionate collectors. It's a passion, it's a lifestyle, and they really cater to them. And our job is to push clients to that right fit, not just to save premium, but to have the proper coverage. And when you talk about higher valued cars, most standard companies get afraid over a certain value. If it's 125, 150,000, they don't even want to insure a higher value car because they're afraid of the loss and the impacts of that, which is where a specialty carrier can come into play because that's what their business is based off of.
I get a question. So for
Yeah.
how, they say, I'm sure you get called in after the after the hurricane has gone through, and like how often do you find that people with these high value vehicles just got regular coverage? Is that you say there's a bit of
It's
a
Wayne.
community in there.
Yeah.
Is it oft do most of them actually, I'll say the word, properly insure their vehicles, or do you find that they basically just went to their regular carrier and got regular car insurance and were just surprised to find out?
Unfortunately, Wayne, most are just with a regular carrier, and they're either because they don't know better or they got what they perceive as a cheap price. And one of my favorite sayings that I stole from an attorney is the cheapest insurance policy becomes the most expensive when you have a claim. So I'm actually working with a prospect now who drives a Lamborghini, and he had a crack in his windshield, and his carrier said, "Oh, take it to Safelight, which is a national vendor for windshields." They said, "We can't work on this car. Take it to the dealership." So the carrier comes back and says, well, since they can't use this, we need to charge you your deductible, which is against Florida statute. Florida statute, windshields are fully covered, and you can't push someone to there. And that made this prospect realize, he goes, if they can't handle a windshield claim correctly, what if something really happened to the
Yeah.
car? What if there's real damage, right? Are they going to know the right repair shops? Are they going to want to pay the necessary bills to fix this? And unfortunately, the answer to that is no. I remember a few years ago, went to a certified repair shop at Chubb, one of the greatest companies in the US and Canada. And they had two Porsches that were involved in an accident. Theirs and their client and the other party who was at fault had State Farm. Since their client called Chubb in, the repair shop actually took the bumper off the car, used lasers to determine that there's no damage to the frame and the car was safe because it was driven by their 16-year-old daughter. The State Farm adjuster came in and says, there's just a little bump. Why did you do all this extra work that we have to pay for now? And the mindset was State Farm wanted the least expensive repair possible, where Chubb was like, we want to make sure that before this car goes back to our child's daughter, it's safe for the road and there's no hidden or unknown damage, and it's worth the cost to us. So those
That
stories
does a
make
that
a
does
difference.
a
Yeah.
sense of ease and comfort just kind of went out the window here, Joe. That's a rather
Well,
interesting story. Wow.
yeah.
Noted.
Noted.
Noted. Well said. Well,
Well, and it's all based
wonder, I
off of
wonder, I guess, so
real.
I guess there's no chance I can get my Lexus to be considered a classic car, age.
It depends if you have multiple cars. So that's the funny thing. Like a Haggerty has something they call the modern collector. So if you have more cars and drivers in your household, they'll look at some cars as what they call a modern collector. That's if it's not driven a lot, if it's a second or third car.
More shall be revealed on that one.
Yes.
Uh, okay, we got to get to our questions. I knew this was
Yes.
going to
Okay.
happen. Um, so the topic today is the three questions high net worth families should ask when thinking about renewing their property and casualty coverage in 2026. So, Joe, be prepared now for the skill testing questions here. Question number one. Now that we're into the new year, I'm looking at renewing my property and casualty insurance. What can I do this year to protect my insurability going forward? Joe, over to you.
Great question. I love that word insurability. Something I say a lot is we focus on future insurability because the P&C market recently came out of a very hard market. We're just getting out of it, so coverage was tough to obtain. But my advice is think like an underwriter right before they see your file. That means investing in risk management techniques, whether it's putting in a wind-resistant roof, opening protections if you don't have those, water shutoff devices. Every home should have that. It's an alarm for your plumbing system. Water, besides hurricanes and natural disasters, plumbing leaks are your number one cause of loss and the most disruptive cause of loss. These can detect changes and potential leaks and alert you or shut the plumbing off to minimize damage, minimize disruption. Make sure you have notes on everything that you've updated in your house. Keep your water heater up to date, your plumbing, your electrical. As you do work, they're going to look at inspections. Pride of ownership. I was talking to a carrier the other day. If the outside of your house is not kept in good order, they don't think the inside of your home is kept in good order. And there's a lot more technology where they are using satellites and drones and other technology to take aerial views and do scores of homes. So it's kind of really cool. And my advice too is before you do any work or renovations, talk to your insurance broker. If you're putting on a new roof here in Florida, the roofer wants to win your business and give you their lowest price. But there are things you can maybe do to fortify your home. The building code people think is the standard. To me, the building code should be the starting point. You shouldn't build to code. The code is where you should start building to, but you
The
should exceed
baseline.
the
Yeah.
baseline. Because guess what? The building code seems to keep changing and changing and changing, getting tougher and tougher. So it should be your starting point, not your finish point.
So when I got, like I said, I got so many questions. I knew
Yeah.
this.
Okay.
So I got one off the top of my head. I'm on roofing. If your client came to you and said, "How often should I look at my roof and replace what the current shingles?" What is there, in your opinion, like a time frame, or do you have an opinion on that? Like
Well, I have an opinion, and we also have guidelines from all of our insurance companies and their underwriting, what their acceptability is. So if it's a shingle roof,
I want the Joe Young take.
okay. Well, the Joe Young take is if you have a shingle roof, you should not have a shingle roof in Florida anymore. We're learning more of the elements, those wear out fast. They can maybe last 10 to 12 years of a good life with the composition shingle. You should really be looking at either tile or metal roof. A tile roof probably has 20 to 25 years. Maintenance, you should be looking at least once a year to check for cracks, damages, do repairs. Metal roof right now, there's still a newer phenomenon, but those can probably go 25 to 50 years, depending on, Mother Nature and that. Remember, Wayne, these roofs are sitting under this hot sun and it seems to get
Yes.
hotter and hotter down here.
Yeah.
And it takes its toll on it. But the key things is maintenance, keeping up on it, having someone look at it. And the biggest misconception is sealing a roof, especially a flat roof, does not work for underwriters. They would rather a roof be replaced because when you seal a roof, if there's already any water or moisture that's been infiltrated, all you're doing is sealing that water in, not letting it evaporate or escape. And perfectly, unless you're doing concrete, flat roof should be a no-no anyways because they cause more leaks. They're not great for wind
They hold
and the uplift.
water.
They hold water, exactly. So, I mean, unless you're putting a concrete structure like a commercial building, which we're seeing in some larger homes, avoid a flat roof whenever possible.
So for high net worth families with multiple properties, including vacation home, what kind of steps can they, would help maintain favorable insurability ratings? And I guess we would call this as kind of a hardening market. Like, what can they do?
Well, in the high net worth space, don't buy multiple homes in the same geography. So underwriters love diversification in geography, not
Hmm.
concentration.
Interesting.
So in Florida, we could do a lot more better work in Florida with some carriers if they also have a home, let's say in the Northeast or the Midwest, because they feel like they are spreading some of the risk with the same client by
Interesting.
diversifying that and saying, okay, we'll take on the riskier Florida risk, which I feel is not as risky as it used to be by insuring the home in Chicago or the home in St. Louis or the home in some parts of New York. Some parts aren't as favorable these days. Have the same maintenance plan and risk management plans for homes. Now, they vary by geography. In the Northeast, you got to make sure you're protecting against winter and freezing. and you have the right, alarms, if you have a basement, that you have sump pumps and you're protecting your contents. But talk to your broker because there's different plans you could do at every home. But the diversification actually works to the client's advantage in
Interesting.
today's market than individual and then doing individual home. The other benefit is if you do have multiple homes, is you should work with one broker like myself because we can always leverage that to give you a good carrier, give you one point of contact, and that advice, and it just seems to work better than having it spread out, not knowing who to call or what to call. We can consolidate your liability. There's a lot we can do when you have multiple properties that we can't do when you're mismatched across the country.
Well, you're singing to the choir there. I always tell people if you've hired two or more financial advisors, you got two or more people you don't trust.
Exactly.
Hire
Yes.
one.
Yeah.
Hire one. Hire the expert's going to give you the advice.
Yes.
So we have, as you know, again, cross-border clients. So for U.S. residents with Canadian properties, or even vice versa, is it possible to align policies across jurisdictions with, obviously looking to protect insurability without duplicating coverages? Is that something you can do? Is that logical, or is it?
It can be done to a point. So there are certain carriers. Chubb is one of the biggest ones who works in both countries. Pure recently, a great company in the US, they recently launched in certain parts of Canada, I think the Ontario and the Toronto area. You may need to have two separate brokers, but find brokers who work with each other, just from licensing standpoints. Like I'm not licensed to work in Canada because I'm not a Canadian resident, but I have friends and partners up in Canada that we can collaborate with. We know the product, so we can make sure that we're not duplicating liability or we're extending liability. That even though it's not as big an issue in Canada, that your Canadian automobiles and properties may fall under your U.S. umbrella. God forbid something happens and you have that coverage worldwide. So the best thing to do is talk to people who have those relationships and can help coordinate. There are some companies like that only operate in Canada, they don't operate in the U.S. So it's really making sure you have brokers who they can't do it all themselves, have a partner, that they can work with, and they do work with.
Our topic today is the three questions high net worth families should ask when thinking about renewing their property and casualty insurance coverage in 2026. And joining me from beautiful Fort Lauderdale, Florida, is Joe Young. He's a senior risk advisor with One Insurance Services. And again, Joe brings, as you've been listening to the podcast, he brings an incredible level of expertise in the areas of homeowners insurance, flood coverage, excess liability, and umbrella policies. He's already demonstrated his expertise here on the podcast. And Joe, we're going to get right into question number two here. I keep hearing that rates are going down, but my premiums keep going up. Why is that? Over to you.
I heard that question too. It's a great question. So the biggest error in that is people often confuse rates and premium as the same item, and they're actually two different items.
Hmm.
Rates are the things that determine the premium. And the easiest way to explain that would be is think of the rate as a block or brick in your house. The cost of that block or brick has stayed the same price or gone down. But due to inflation and supply chain, you need more blocks or bricks to rebuild the
It's
house.
a good
So,
analogy.
well, thank you. So in some cases, why the cost per brick has stayed the same, a $3 million home is now maybe going to cost 3.7 or 3.8 million to insure. So we have to
So
that's
more
the factor.
bricks.
More bricks, unfortunately, but the underlying rates, the cost per hundred of coverage, those have started to stabilize, in some cases gone down. It's just the coverage increases are causing the premium to stay the same or change a little bit because you need more of that rate to cover the home.
So we have high net worth homeowners that, live again, coastal Florida.
Yeah.
Uh, how do factors like inflation on rebuilding costs or reinsurance pressures override general rate of declines and drive into premiums up?
So, I mean, like Wayne, I'm sure in the last 4 to 5 years, we saw average increases of 10 to 12% a year to cover for inflation, as
It's a California thing too, by the way. I have friends out
it's,
here who will tell you the same story.
it's a countrywide thing, as cost of appliances have gone up, cost of materials, cost of labor have changed significantly in the past 5 years and continue to get worse. So as those change, as premiums offset, like I said earlier, coverage gets higher. So they can run models, they can look at data, but the key factor there is inflation, is having an impact on your premium. I recently looked at a client's policy and the coverage went up about 7%. The premium went up 4.5%. So that shows me they actually had a little reduction, right? Of about 2.5%. Their total
Hmm.
The total premium went up, but not as much as the coverage went up. And that's something I always look at when reviewing a client's files is what's my change in coverage percentage versus what's the premium change. And that gives me a clearer, look into how their program is performing and what we have to look at.
So let's go to question number three. That's great. And again, I think the biggest mistake that people make when it comes to a lot of services, including insurance, hiring a good attorneys, is always looking at the bottom line and making a decision on, what am I paying? I realize everybody has, certain limits to their capability of paying for whatever the service is, but uh, what's the word? Cheaping out on insurance coverage, hiring a really cheap attorney. Two of those things, those usually don't have good endings, usually.
And before you get to this question, I mean, insurance is a legal contract, and no two policies look the same. People look at it this way.
That's right.
Companies operate and treat claims differently, just like we have different vehicles. You have Toyotas, you have a Lexus, you have Mercedes, you have BMW, you have different tiers. They're all good cars, but they have different features and functionality, and that factors into the pricing, right? But an insurance policy is a legal contract.
100%.
And some could be 80 pages, some could be 200 pages. That's because they're homeowners doesn't mean they're the same thing. It's not a red apple and a red apple. It could be an apple and a peach as far as I'm concerned.
Or a
You really
Honda
have to know
Pilot.
what's in that document.
And that's what they hire you for.
That's what they hire us for, yes.
Okay, Joe, let's get on to question number three. Here we go. I'm looking into building a new home this year. What should I be looking for when applying for a builder's risk policy? And I got to say right off the bat, builder's risk policy is probably something that not most people aren't familiar with. So
Well,
maybe a
thank you.
little education on that as well. So I'll turn it over to you.
We got to. So builder's risk policy is different than a homeowner's policy. It's more the construction policy. It's going to cover the cost of the project, the finished project from inception, for a builder to come in and either build your home or renovate your home. One of the biggest issues we have with builder's risk is we're offering called after they finalize the contract with the builder, actually after they finalize the plans, and sometimes that leaves issues that are very difficult to resolve. One of those being a waiver of subrogation, where the contract says you waive all rights of subrogation. Subrogation is my ability or insurance company's ability to go after the other party for wrongdoing or negligence they had. So that could actually make a lot of the carriers say, we don't want to insure that, or it could add a 15 to 20% surcharge to a policy because it's putting more risk on your carrier. A good builder's risk policy is going to cover the project through inception. It's going to cover the materials. It's going to cover liability. It's going to cover soft costs. It's going to cover cost overruns. If you're dealing with one of the better companies out there, like a Chubb or an AIG, they're going to send a risk management team out there that's going to give you a risk management plan during the thing, whether it's storing rags, I know smoking signs, security on the site. The other issue with builder's risk is we talked about insurability. Talking to your insurance broker prior, Joe, I'm thinking of building a home. I can give you items to consider that the builder may not want to, like installing that water shutoff system into the home pre-construction, putting vents in the garage and the lower slab of the home for floodwaters to flow through, instead of installing that after the fact and having to cut, concrete out. Why not build it into the house? Maybe it's the roof design. Maybe it's putting double straps here in Florida instead of clips on the roof to tie the trusses down. For the flat roofs, concrete costs more, but it's going to make the home a lot stronger than putting a wood truss roof, under a flat roof. So there's a lot of input we can provide. And we can also review the contract before you sign it. And we have teams that look at that as well in our carriers. They can review the contract to look for any errors you have. The other key tip when looking at a builder's risk policy or construction project is you're going to ask your contractor for their liability policy. And you want to make sure they have limits that match your project. If you're doing a $10 million project, $1 million of liability, and the builder leaves you very uncovered. The other thing I always ask for is loss runs. Ask the builder and their broker for their loss runs. Because a commercial liability policy, different than most personal policies, is an aggregate policy. So all the losses add up to the limit. It's not per loss. So if your builder, your general contractor has a $2 million policy, but they've already suffered $1 million of losses, they only have $1 million left for you this year. And you can also question, why does my builder have so many losses? What's happening? It could tell you about, sometimes bad things happen or accidents, but frequency, severity, and claims details can help you vet the builder as well. So it's always good to ask for those loss runs as well.
So the
But talk to your
builder's risk,
broker.
just one question. So
Yeah.
the builder's risk
Mhm.
The term builders, we're referring not to the homeowner looking to build, but the actual builder being
The
hired to do
building
the
higher, right?
build.
It's the homeowner, the future homeowner protecting their investment in building that project. Right. And the other problem with builder's risk is you need to secure coverage prior to the project starting. The more a project gets along, the tougher it is to get insurance on that. Because the reality is the more a project goes along, losses become much more frequent, especially as liquids and chemicals come out, they can tend to fires. The majority of losses on a construction project actually happen about the last 10% of the project. So underwriters don't like that. You
So
know, they
if it's a tear down and a rebuild up, it's better to even start talking to the insurance broker before you start knocking walls down on the existing edifice.
get the process started right. And once demolition happens and before the foundation work is done, your builder's risk policy should be in place. As long as there's not four walls and a roof or multiple walls and a roof. You can't say four walls anymore these days, Wayne. We've seen houses, but before walls and the roof go up, you want to have that coverage in place from the inception of the project.
Got one more for you on that
Yes.
one. So I bet you this happens, and I'm not even an insurance broker. I bet you this happens. So what can happen when there's a transition from a builder's risk to a permanent homeowner's insurance policy, right? And how can the homeowner, the high net worth builder, avoid a coverage gap? I can just see right now they're on this builder's policy and they're in, like this happened before, people move in before the project's completed. So they don't bother getting the coverage until the last
Well, and
truck
Wayne,
has left the spot.
and that's where it gets tricky because a builder's risk policy is not supposed to cover occupancy, so it's not going to have those full coverages that you would find a homeowner's policy. But a homeowner's policy doesn't want the work going on, so you really shouldn't be moving in until the certificate of occupancy is issued. But the other tricky thing is on some builder's risk policies, you might have a policy that says it goes from January to January, but there's a clause in there that says coverage ends when the project is done or the CO is issued.
But whether there's a delay in getting the project done.
Done, but let's say the project's done and you don't replace with a homeowner's policy. That builder's risk isn't going to cover the finished construction or the occupied construction. It's not a homeowner's policy. Coverage could, even though you paid for the year, if the project's done in 11 months, your coverage ends when the project's done. So the best thing to do is to start talking to your broker about 30 to 45 days out, saying we're near the end of the project. Let's start working on alternatives. Now, if you're with one of those high net worth carriers, their risk management team may already be in the loop too and help guide that process and help with that transition. But it's really two different animals. You have the builder's risk until the CO is issued, and the homeowner should start when the CO is issued. Now, the CO is not completely infirm as long as the builder shows there's no punch list, the work is done. Some carriers understand, the government takes time, local municipalities take time, and they'll be willing, on a case-by-case basis to make exceptions and issue coverage.
So we covered a lot here today.
And wait, I'm going to add one more thing because you mentioned the word renovation. If you're doing a
Yes.
project on an existing home, your homeowner's policy may, be void based off the amount of work without reading the contract, or a large special deductible may be applied. So again, unless you're like replacing a carpet, if you're doing any type of work in your home, you should let your broker know and let them work with the companies to make sure you either have the right coverage on that policy or you get the additional coverage you need to protect your assets. And your home is usually the biggest asset most people own.
Yeah, that and their ability to make money
The ability to
usually
make money. Yes,
is.
exactly.
Yeah,
Yes.
there's
Mhm.
no, but your point's well taken.
Yes.
Um, I wonder how many times you have conversations with people who just overlook all of these things and they're looking to put the toothpaste back in the toothpaste container, and it's not too easy.
Not too easy. When it's too
Um,
late, it's too late, unfortunately. Yes.
yes,
I like
right.
that.
Locking the barn door after the horses ran away, right? So like I said, we've covered a lot here.
Mhm.
What would you say would be one key action a high net worth family could take right now to be better prepared for their 2026 property renewals? What could, if there's a one thing, if you could suggest?
Is start the conversations early with your broker, maybe 6 months out. Start the process. Let them know of any changes to your properties, your family, kids moved out to college, going to college, any new acquisitions, if you bought new art that you haven't told them about yet, jewelry. And start the conversations. Start talking about any anticipated projects you're doing in the house. The reality is insurance shouldn't be a one time a year conversation. It shouldn't just be renewal time. Your broker should be talking to you. You should be reaching out to them throughout the year when things in your life change. But waiting till the last minute is going to put you in a bad position. Yeah, especially in the high net worth space, it's not Geico, it's not Allstate. Quotes don't happen in 10 minutes. We have to go talk to underwriters, talk to leadership at carriers, negotiate, talk to risk management. Sometimes it could take us 2, 3, 4 weeks to get work done because of the back and forth and working with these partners. So don't wait. Have conversations.
This is a question I
Yeah.
just before we wrap up here, and we're just about running out of time here, but this is a question I ask almost a lot of the people who come on the podcast, and it's as you know, technology is evolving, and AI is obviously influencing everywhere. So, how are AI-driven rate predictions changing the landscape in your space?
Well, AI prediction is in a couple ways. It's making it easier for underwriters to model. They're doing more instead of you looking at a whole area, they can actually rate based off specific locations. Technology has become a key underwriting tool, whether looking at aerial photos and doing roof scores. I've had a few carriers come back and say, we need to get an inspector out or drones out because we're not sure about the roof of this house based off the satellite or roof scores we're getting. So technology is becoming a key factor in the underwriting thing, behavioral. But it's also giving more time for us to fill in those grays and to look at the behaviors and to talk to clients. And also technology, which is my opinion, is going to affect insurance more in the future as we have more connected devices. And as homes get smarter, it's going to share more information with the insurance carriers. And they're going to truly know that Wayne did keep his temperature in his house correct during the winter season and it didn't get low. Or if it got low, he fixed that. Or Wayne he has a water shutoff device installed and he's actually using it. He didn't turn it off because it was an inconvenience, but he was really into protecting his home. So there's going to be
You
more data available to underwriters.
you just segued into it. One last thing here: cyber risks becoming a thing, right? So, how do families stay ahead of that risk?
Well, that's a great question. That's an emerging part of the high net worth space. So cyber is scary. As we mentioned, AI, there's more and more risk out there, whether it's voice spoofing using AI. If I'm speaking to Wayne right now, I can see him, and you're one of Wayne's clients, and you get a call, and it sounds like Wayne, and it says, "Hey, I need you to wire money to XYZ," and you said that sounds like Wayne, and there's not more protocols in place, and that money goes to China. It's not coming back. It's having a family strategy for devices, right? Using VPNs, using separate networks for your Internet of Things devices, whether it's your cameras or your smart assistants, should be on a separate, maybe not router, but different network internally. Split your networks than what you connect your laptop or computer to do your banking. There are cyber insurance policies now that can cover your financial loss, things including things like crypto. And they include the best part, and they include software that can monitor the dark web and protect these devices. And they're very inexpensive. The key problem there is everyone thinks it's not going to happen to me. But we've seen many cases, even with celebrities and famous people, where there's a lot of spoofing of personalities where a criminal may learn Wayne or Wayne's staff's personalities, can spoof his email, they can break in, they can learn the way they write and trick you into sending money or wiring money, thinking you're dealing with what is a trusted partner. So it's having protocols in place, making sure you and your wealth team, your tax team, have a plan in place, before these things happen. It's not the old days where I got an email from Wayne. Yes, I'm going to wire the funds. You need more
No,
authentication.
yeah, that's 100% true
You know,
here. I can tell you that right now.
oh,
That
oh, I know it is. I'll just use it as an example, but it's really
but
just having those policies in place, making sure your kids understand that if they're on social media too. I fight with my wife all this time. We're going on vacation. Let's share the photos when we get back. Let's not let people know
yes,
we're away for 2 weeks.
yes,
Let's we
exactly
can
right.
celebrate when we get back, but don't, too much is shared today. But cyber is not just for businesses anymore. Individuals are being targeted, and it's really prevention, having the right technology, and having the even the policy is great to cover your financial losses. I mean, I've had
We
prospects
probably could
come.
do a podcast show just sitting here or standing here right now. We probably could do just a whole podcast on that one alone.
It is, but I'll
That's a
be honest,
future.
Wayne.
That's a future. That's a future. That's a future.
I like to sleep at night, and the more I think about cyber, the less I like to sleep because it scares me.
Yeah, well, okay. So, any final thoughts? as we're going to wrap up here, and I appreciate you making extra time for me. I know you got a busy day ahead of you there. Any final thoughts on the biggest opportunity for families to enhance their risk management and be fully prepared for whatever brings them this year?
Yeah. Yes. And I like the word too that you use, risk management, not insurance. Think of it as part of your wealth plan. You accumulated these assets, you worked hard for that. How do you protect them? How do you protect your family? It's bring your teams together. It should be your wealth team, your attorneys, your CPAs, your insurance broker. If they can't talk together, work together, something's wrong with your team. And be proactive throughout the year, because the last thing you want is to have an uncovered loss, pull money from your assets. If you have a $5 million claim on your home and you have to remove that from your investable assets, that claim's going to cost you more than $5 million. It's going to cost you the money to repair. There's probably going to be a tax penalty on having to sell assets to cover that. And you're missing on the opportunity cost of that. So there's different solutions. Now, I'm not saying insurance is 100% the risk transfer, because a lot of it can be mitigation, planning. Some of it could be self-coverage to deductibles and retention, but it's really having that conversation and making sure your whole team is on board with it. And then it's not a one-time sign here, done, that is an ongoing part of your wealth plan.
We have people, like I said, listening, watching all over North America. I do want to make a point here that, we have put all your contact information below you on our screen here for the people watching. For people listening, what is the best way for them to contact you?
Give me a call, my cell phone, 954-529-3706. Call me, text me. If you like email, it's jyoung@my1oneins.com. And I can work throughout the country in the U.S. So it doesn't matter if you're in New York, California, Florida. I'm licensed in every state and can be a great resource. And I have good friends in Canada if you need that.
Perfect. Joe, thanks. You were awesome. And we are definitely going to be doing a follow-up podcast, guaranteed. That's going to happen.
Good. I'm going to hold you to that. This was fun.
Yeah, don't worry. It's going to be prepared. Joe Young is a senior risk advisor with One Insurance Services. He's based in Fort Lauderdale, Florida. Joe, thanks a lot. Great seeing you. And we'll, as they say, we'll have you back soon. Thanks,
Looking
Joe.
forward to it, Wayne. Thank you.
I look forward to bringing you the 3 Questions podcast, and I hope you find them educational and informative. Please consider liking this video and subscribing to our podcast and YouTube channels. And to receive a notification when our latest episode has been posted, please click on the notifications bell. Lastly, to schedule an online Zoom consultation with me to discuss your wealth management needs, please click on the link in the description box below, www.onecapital.com/meet with Wayne. Thank you, and we will see you soon.